Back to this session about some important terms in relation to the economics in a business. Terms as contribution margin, profit, break-even revenue, break-even sales, and so on. We shall discuss that in the next couple of minutes. Contribution margin is a term which is used very, very much because it's telling us how much we actually make in profit on each product. So as you can see here, the definition is the revenue minus the variable costs. And normally in trading companies, it's easy because then you buy something and you sell it at a higher price. It's a little bit more complicated when we talk about a process or a production company where various elements is calculated in as cost. As for instance, in a restaurant, making a menu where you have to calculate, well, how much did you actually put in this menu? How many grams of steak, how many grams of salads or whatever. So you have to calculate what is the variable cost. And then you can calculate the contribution margin of the menu by taking the sales price and deduct the variable costs. Then you have the contribution margin per unit. Okay, and when we talk about profit, well, then we'll go to the bottom line on our profit and loss statement. And here we have also deducted all the fixed costs. And we know the difference between the variable costs and fixed costs is the variable cost will change if the sales change. So, as we talked about before, we cannot sell a menu without using the steak and the salad or so. So whenever we sell a menu, our variable costs will increase. Whereas fixed costs, well, they can change, but they are not depending on the revenue. So that's why we call them they are fixed, even though that they can change. In 1 month, you can say we use much more water in the production, or it's a bad example. We can use more marketing efforts, marketing costs, but we didn't sell more. So that's why we say that marketing costs, in fact, is a fixed cost. But enough of that. Variable costs, fixed costs, we know the difference now. So the normal way we put on a profit and loss statement is that we start with the revenue and we deduct the variable cost, and then we have the contribution margin. So the contribution margin is what's left for covering the fixed costs and hopefully giving us a profit when the fixed costs also have been covered. So this is total, and we can see per unit we use, of course, the same concept, but then revenue is converted into a sales price and the variable cost is per unit. We have the contribution margin per unit and so on. And we can just go through an example. Let's see if you can follow this one. It's a company. It sells 250 units as a sales price of 400. Variable cost per unit is 200. And fixed cost for this period is 45,000. So now we should calculate the contribution margin and the profit. What is the profit for this company here? Well, revenue, we know we calculate the revenue by saying number of sold units, that's 250, multiplied by the sales price, and that was 400. Okay. Now, how do we calculate variable cost? I'll just give you 5 seconds to answer me on that. In the meantime, I will I will just put in to format this cell here, so it's easier to see what's use this 1000 separators. So did you come up with the answer on how we calculate the variable cost? Variable cost is depending on the sold unit, number of sold units, because we know that variable cost is changing when the sales is changed. So actually, if we sell nothing, variable costs will be nothing. But here, actually, we sell 250 units. So it is 250 units multiplied here by the cost of each unit. And that was 200. Okay, and now I can deduct the 50,000 from 100,000, and I have a contribution margin. And the fixed cost, we were told that was 45,000. So I'll just tip that in, 45,000, and I can deduct that from the contribution margin. And I have a profit of 5,000. I'll just make them all with 1,000 separators, like this. So this is total. And of course, I can do it per unit also. And it's just to divide these with 250. And I can drag this down. So the profit per unit is 20. The contribution margin per unit is 200. And the fixed cost per unit is 180. Of course, it depends on how many units I'm selling, because the more units I'm selling, and with the fixed cost not changing, then the cost per unit, of course, the fixed cost per unit, of course, will decrease the more units I sell. Okay, so now we know about contribution margin and the profit, and we know about variable cost and fixed costs. So now I'll move into break even. Break even is quite important to know, especially if you are considering starting up, because now if this here was, you know, a budget, a forecast, what we expected, if we would open up a business, then we can say, well, this is what we expect that we will do every month. Let's say it's every month, and every month we have a fixed cost, rent, salary, and so in total of 45,000. And every month we'll make this contribution margin. Then we can say, well, okay, every month we'll have a profit of 5,000 after our salaries, perhaps our own salaries also, has been covered. But in fact, we would like to know the break-even sales. And the break-even, you know, measured in sales is how many, sorry about the spelling here, how many units must be sold to reach a profit of 0. Or in other words, to avoid making a loss. Now, starting up, of course, this is quite good to know. Then we can estimate if this is really possible, if it's feasible for us to reach that number of selling. And if we say, well, we'll never get this sale, then of course we'll not start up the business. So how do we calculate the break-even sales? Well, it is the fixed cost divided by the contribution margin per unit. And in this case here, we have the fixed cost, and we can also calculate the contribution margin per unit. So we have different break-even terms. We have break-even sales, so that is the break-even sold units, but we also have break-even turnover. So if we want to know how much turnover do we want to make in order to avoid loss. And of course, sometimes, very often in fact, we start up a business selling more products, different products. So it is a mix of various products. And then of course, it's perhaps not so making so much sense of making a break-even sales of one particular product. Then it's more important to say how much turnover would we like to have in order to avoid. And here we will see that the formula is the break-even sales multiplied by the price, or perhaps even better, the fixed cost divided by the contribution margin ratio, which is an calculated average of all the products. If we have, for instance, 10 different products, then we will see, well, what is the contribution margin ratio for these products. So, but maybe it's better to show a solution, an example here, where we can say we can calculate the break-even for this above company here. How much do they have to sell in order to avoid a loss? Because you can see if they sell nothing, of course, then they will have a loss of 45,000 because they still need to pay rent and other fixed costs. So how much do they have to sell? Well, break-even sales, the formula was the fixed cost divided by the contribution margin per unit. And the fixed cost was 45,000. Oh, sorry about that. 45,000 divided by the contribution margin per unit. And that was 400 minus 200. So I can divide by 200. So they need to sell 225 units every month. And they expect, or they normally sell 250. So they have a safety margin, so to say, of 25 units. What about the revenue? Well, that was the break-even sale, so that we can take that up here and multiply by the sales price. So I can take this one and multiply by 400. So they need to have a revenue of 90,000. Today they have 100,000. Okay, so we could control if this is in fact correct. Let's say that actually we have a sale of 225 giving a revenue of 90,000 1 month. Let's just try it and say, okay, it's 225. We know the formula for calculating the revenue. It's a number of sold units times the sales price. And the formula of calculating the variable cost is the sold units multiplied, but now with the cost price, and that is 200. Okay, and now again we can calculate the contribution margin, and that is the cost of revenue less the variable cost. And here we can already now see that we will in fact reach a 0 in profit. So when we sell 225 units and having a revenue of 90,000, we will have a break-even profit. So that is the break-even sales and the break-even revenue and the contribution margin, fixed cost, variable costs, all very important terms that we will work with in planning the profit making in any business. Good. Good luck with that. I hope you enjoyed it and can benefit from it. See you next time.